Meghan Shue is head of investment strategy at Wilmington Trust. It's good to see you today, Meghan. Let's talk a little bit about first why you think the S&P 500 could go down another 5 or 10%.
Thanks, Contessa, for having me. So I think the way we think about it is that we've talked for a while about the risk of recession being elevated, and we now have moved our base case to expecting a mild recession in 2023. And I think the way I would look at it is that if the bottom is in for this market, it would be pretty unusual to have bottomed this far ahead of the start of a recession, which we expect to be a first half, possibly starting in first quarter of 2023 story. So I think the timing is off for the bottom to be in, but I don't think we need to go much lower than we've already seen in terms of the drawdown for the S&P 500, which at 25% for this year max drawdown is very much in line with the average for a mild recession. And we don't expect anything nearly as severe as what we saw in the last few recessions. We expect some softening of consumer spending and CapEx, but the job market is so tight right now that it's really hard to see really massive layoffs happening in the economy. So I think we're talking about a short, fairly mild recession, and there could be further downside, but we're not getting defensive at this level.
And I mentioned China at the top here. How does that factor into what you anticipate coming down the pike?
Yeah, China is a huge wild card. Clearly, a lot of news stories over the weekend about the possibility of a relaxation of their COVID policy. It's something that we've been watching carefully. And when you think about the COVID policy, along with the geopolitical risks, whether it's conflicts with the U.S. over tech trade, or even the risk to Taiwan, there's definitely some inflationary risks emanating from China in 2023. I think oil is a big story there. 2022 is one of the largest declines in oil consumption for China that we've ever seen, I think outside of just 1 year in the 90s. So if we look at a return to growth in oil consumption, which is what the EIA expects, then we'd be looking at increasing demand, and that could lead to some higher pressure on oil, basically a continuation of the climb higher in gasoline prices that we've seen in the past few months.
So if I put together a couple of the things you've said, I come up with this. You think there may be a mild recession. You think that the market may go down in the S&P 5% or so, thereabouts. This would all imply that you think interest rates are going to continue to go up just a bit. How high do you think interest rates need to go to kill inflation?
So that's the million-dollar question, definitely. We now expect the Fed to have to raise rates likely north of 4.75%, probably more like 5% in terms of the Fed funds rate. And that would suggest more pressure on the short end of the curve. Interestingly, we don't expect the 10-year Treasury yield to move too much higher. We think, in fact, it's more likely that we see a further inversion of the curve.
Shepard Smith here. Thanks for watching CNBC on YouTube.